All right, everyone. Welcome to the Profit for Contractors podcast. I am your host, Austin McGinnis, CEO of Profit for Contractors, CEO of Team Builders, a $10 million general contracting business in Iowa and Florida. And I am so excited today because we're going to be talking about the contractor that just had their best year ever, right? Their revenue's up, their jobs are stacked, but somehow they're still stressed with their payroll, their cash flow, paying vendors and subs. And today I'm really excited. I got Anna, who is our Profit for Contractors financial coach. She's been with hundreds of contractors throughout our program, and she's going to talk about this problem from an analytical standpoint. Well, I'm going to be speaking about some of the examples that I've seen in my business, and it's typically not a revenue problem, Anna. It's typically really a financial systems, a financial process problem, sometimes getting down to the details of your contracts and how they're laid out. So, Anna, have I done a good job of introducing you? Is that, anything else you want to share? You're good?
I'm good. The
All
rest
right.
will give away my age.
Well, let's get into it. So why does this matter? Today, we're really going to be talking about how growth in your business, how you scale, can sometimes hide those bad cash flow habits. And they expose it really as you scale. The busier you get, the bigger the jobs you take, the easier it is to start missing those leaks until the bank balance ends up going quiet. And then winter hits and all of a sudden you're in a cash crunch and having to react to the cash pinch, even though you scaled and grew, when if you would have just planned accordingly ahead of time, you could have been more proactive instead of reactive on the back end. Okay, so first pain point we're going to talk about today, Anna, comes down to timing, right? In prior years, maybe your company's been a smaller revenue. For instance, in my business, we were doing kitchens and baths, and now we're doing custom homes and home additions, right? Large remodels. And the busier we've gotten, the more complacent we've gotten, where we had systems back in the day with a smaller team and smaller jobs. Those systems don't necessarily hold up as we've grown in our projects. So for team builders, for instance, that's the example, right? Back in the day, we did smaller projects, we did bathrooms and kitchens, and now we're doing these large custom homes. And our terms before were maybe like a 50 on the front end for a deposit and then 50 when complete, right? And that works for a bathroom that's only going to take 3 to 6 weeks for install. And better off would be maybe more of like a 33% down, 33% after rough in, and then 33% final, trying to get more, 66% of the cash up front. But now that we're building homes, 50% down on the front end, 50% on the back end, those terms just don't work, right? And as we've taken on more projects, the cash flow starts to pinch us if we remain using those similar terms. And so we've really had to relook at our entire draw schedules and make a lot of changes on how we work with clients, what our contractual terms state. And that's been one of the biggest changes as we've scaled from a $1 million contractor today. So I'm curious what you've seen inside the walls of PFC with the clients that we have, and what kind of solutions you helped work contractors through, and what things you saw that have made an impact to their systems, their contracts.
What's happening with a lot of our clients is they just abandon some of the cash flow systems they may have had in place. They think, oh, money's coming in. We've got these bigger jobs, so more cash is flowing inwards, but they're forgetting about those outflow obligations and the timing. A lot of times when our contractors grow, the timing shifts. So, which means our system may not be broken, but it just needs to be tweaked to reflect it. And so it's really important for our clients to just go back to the basics and start applying some of the old cash flow and watching what's coming in when and what's going out. And maybe also updating those those draw schedules. Maybe now we're looking at a 10% down just to get a date in. The first day we're on that site, we're looking at $40,000, like 40% down. And by the end of the project, we're leaving less money on the table. Maybe we're only leaving 10 to 5% on the table to be billed at the end to help improve that cash flow timing.
Right. So in the instance of a contractor, let's just say they're scaling, right? They've gone from 1 million to 2 million, or maybe even 500,000 to a million, right? Let's just call out a drywall contractor or a concrete contractor. And they've started with, patchwork jobs, and now they're doing, full homes and renovations, right? What kind of terms should they be looking at changing in their contract to improve their cash flow, to ensure that they're being protected of the strains of ordering more materials, having more labor, and maybe even a bigger gap of payables if they're working for GCs now instead of just homeowners?
I think the biggest thing is having your cash flow in order so you know what's going on when it comes to the cash flow. That's the first thing we're looking at. We're looking at seeing how we can work and change those draw timings and everything else. Because what ends up happening is when we get into these bigger jobs, we end up cash flowing a lot of the job until the payment. So you're paying your employees next week, but you might not be paid for another 2 weeks for that. So it's changing those draws so that you're actually getting your payroll before you're paying your guys. So we're trying
Mhm.
to tweak them as best as we can and work with the GCs.
Yep. And as a GC myself, I see a lot of different subs that have different organization, right? My best subs from an organization standpoint, from a quality standpoint, and just overall communication standpoint are the trades that are wanting, a large chunk up front. They sometimes are 20%, sometimes 30%, some of them even 50%. And they're very astute on getting that before they start. They're sending invoices maybe after drywall's hung or after, form work, like they have maybe a milestone payment, and they're getting, multiple hits of cash flow from even me as the GC. And a lot of GCs, right? We have our own internal process. For our process internally as a GC, we typically are like, hey, if you get us your bills by Thursday, we'll have them approved by the following Tuesday, and then checks cut by the following Friday. So I'm almost requiring all of my subs, because I used to have so many sorts of guys being, hey, I just invoiced you. Can I pick up the check tomorrow? And that worked when we were smaller, right? And I was typically the one cutting the handwritten check. Now we have kind of a bookkeeper and a process internally for team builders that actually lines that out, and we put that in our subcontractor agreements now. So that's one of the things that we've done to also protect our cash flow of outflows, right? Because cash flow isn't always just the inflows, and I think we've really focused on that in this conversation to date, but it's also the outflows of paying subs, paying vendors, right? So that's our internal process. Invoice by Thursday. And if you invoice me Friday, you're not being touched till the following Thursday, right? So I need your invoice by Thursday. We will approve it the following Tuesday as a team, whether that's the subcontractor or the superintendent or the project manager actually reviewing that bill and approving it, making sure that it was in line with the estimate that they received and any potential change orders that came from that. Gets approved. Bookkeeper then, cuts the checks, runs the payroll, makes sure the cash is all good for the week. Checks are sitting there ready for pickup Friday. Do you see yourself talking to our internal clients about that kind of a process for them? And what would maybe that look like for a subcontractor?
That process is really, really ideal because that's what a lot of the big boys in the industry do. Our bigger GCs, our bigger concrete guys and stuff, they have a system. They're not running checks and sending checks out because somebody wants their money today. Like they're setting down the rules, and setting those payment rules is helping you control that cash flow outside as well. So putting it in your contract and saying, "Hey, we have no problems paying you, but we need a week turnaround in time
Mhm.
to approve it and everything else," is very standard. And those are things that we try to get a lot of our contractors putting into. You're creating a system when it comes to when your clients pay you, but you also want a similar system for how you're paying your vendors and making
Mhm.
it all clear, because that does save your cash flow and really help you be able to plan to know what's coming up
Mhm.
and how much is being paid out, so you can have a better glimpse of it. That's great, but to also realize and look back at your contract and look at when things are happening on your job board to find out what payments are also coming up, because that's going to tell you what's come in and what you have to pay. But you need even a further foresight to see, okay, if I'm going to be finishing concrete this week, that means the next week I've got to pay the guy because I'm giving a week turnaround.
Right.
So you also have to take it to that next level. It's great to see what you have in your system today, but the problem is until it gets in, you still don't know what cash flow is coming out. So you
Mhm.
need to create a system for that too. And that's why
Well,
production boards are great.
and I think one of the things that I find myself reminding our clients of in coaching calls is like having the time block in your calendar to actually review cash flow, to review invoices and actually send those out, right? So if you know, hey, I work for these three GCs, or if I am the GC and I'm working for these three big clients, right? I need time to allocate on a weekly basis. Like I take a 2 hour time jump, typically on Mondays as I'm starting the week, knowing where I want to be by the end of the week, right? And I'll take that 2 hours, I'll sit with my bookkeeper, and we'll go through the clients, right, of income and what's billable, right? Certain people are on draw schedules, certain people are on milestone payments, right? And then I'll also look at the incoming bills. What bills are approved that we need to pay this week? So we know kind of what the inflow, we know what the bank account is. We know what the projected inflow is for the week. If we get payments, invoices we sent last week that we're anticipating checks arriving in the mail this week. And then also what subs and vendors are requesting payments, the timeliness of our credit card. Our largest supplier is on a 30-day net. So their bill comes monthly, right? So as we go week to week, we have that protected time, right? And I think that's one of the foundational components of PFC is like just getting guys to stack and time block their calendar to be able to work on those business activities that keeps that cash humming, right? Anything to add on that?
I find the one little piece that you need to add is your project manager guide to tell you what's coming up for where the jobs are at. If things are ahead of schedule and your concrete guy is going to be billing you a week early, that's going to impact your cash flow. So you're going to have to adjust some of those schedulings as well. But like this is a living document that needs to be looked at and reviewed weekly. So you need to know what's going on at the job level to also impact that cash flow because that means you can bill your client maybe a week earlier because concrete was a milestone, which
Mm-hmm.
means that's going to impact what cash is coming in and what cash is coming out. So paying attention to those, what's going on down at the job level also
Mm-hmm.
helps you build your forecasting for your cash flow as well.
Right. Yep, and that kind of goes back to setting those terms on your draws, whether that's terms with subcontractors and vendors and terms with the homeowners, right? So that Thursday, Tuesday, Friday kind of cadence is kind of stretching your ability to actually pay those, and you can see them coming in before they have to go out. And then if you have to have a difficult conversation with a sub about an invoice that, hey, we don't agree with this price, you overbilled us or whatever, you can sort through those things leading up to that Friday payment. Next, I want to shift into kind of how we go from, you know, point A of maybe running some smaller jobs, having quicker payables to point B of doing larger jobs, and I'm stacking larger jobs. And all of a sudden I went from, the $1 million contractor to the $2 million contractor, and I'm doing more volume. All right. And my average job size is bigger. And if I haven't switched my terms, that could lead to issues. All right. Which is going to make me reactive. Um, and I want to talk about the necessity potentially for that line of credit, right? So as you start to get into bigger jobs, especially if you're working for bigger GCs, they're going to have different payment terms. And as you grow and build out your relationships over time, those payment terms are going to be critical. And then if those payment terms aren't conducive to the cash flow, I may need a line of credit, right? And the time to get a line of credit, as everyone should know by now, is to get it before you need it. Otherwise, when you need it, they're going to look at your books or you're talking to a bank about getting this line of credit, and they're going to be like, your cash flow is kind of like fizzling out, right? Then you're becoming more risky. You're not getting really great terms, right? So ideally, before you scale and maybe as your cash flow is looking good, is the time to go and ask the bank for that. Is that correct?
It's always the time because they're always going to want when we need something, that's normally when we're told no. You need to get a credit card increase, but
Mm-hmm.
they're going to say no. It doesn't look good because things are starting to bottleneck up Whereas when that money is flowing through the bank account and you don't need it, is the time we ask for it. We don't have to use it. It's just there. We don't
Mhm.
pay interest on it because we're not utilizing it, but we're using it. And that's one of the real keys. A second thing that we can do as well is for specific jobs, have a talk to your supplier and maybe get extended terms on this particular project. Maybe you need a
Mhm.
45-day term versus a 30-day term on this project.
Right. And if you give them reason for that too, right? Because it's like on a bigger job, maybe it's a bank finance job for your customer, right? So whenever you bill them, it's a 2 to 4 week delay in you actually getting the payment from them because they got to go get it from somebody else too. So letting a vendor know of that and letting a subcontractor know of that too, and they help share that burden with you. One of the other things I wanted to bring up was, um, the practicality of, you know, the the process of your draw schedules, right? So going from, milestone terms to a draw schedule, right? There's a difference in job size there, right? Smaller jobs are on the milestone base, larger jobs on a draw schedule. My team in particular, um, we recently literally just talked about this is like the flow of these bigger jobs, right? It's ideal to stack them in a sequence where it's like, okay, we're going to break ground on this one this month, right? And then next month or in 2 months, we're going to break ground on the next one. And then in 2 months from there, we're going to break ground on the next one. That's an ideal scenario where then each project is in different phases. I'm never breaking ground on 3 projects at once, right? I'm always breaking ground in rough in or in punch out is kind of the ideal situation. That makes sense in a vacuum, but that's never really the reality, right? You're promising homeowners start dates, you're promising homeowners, when your completion is going to be by, and juggling that can kind of become difficult. And oftentimes, as much as you plan, it's still like you have a plan until you get punched in the mouth, right? And so if I didn't have really good payment terms and on a particular sequence right now, I have one homeowner who is working with an architect on their design that's separate from my contract. So I'm kind of like in the middle of like a homeowner architect figuring some things out before I can even start. That's delaying. It's out of my control and it's delaying when I was thinking I was going to start. There's another job where a homeowner has a VA loan, and a VA loan is much different than just a conventional loan from the bank. It's more paperwork, more things that have also delayed the project. And then I have a third project. And ideally, I had this plan for stacking all these in that way where I was breaking ground on one, going to be in rough in, and then, being in punch out on a different one. And now I'm in a scenario where this particular private owner that I'm working with on a really big job kind of is big enough to actually dictate some of their own terms. So they kind of told me, like, hey, this isn't going to be how it's going to work if you're working with us. This is kind of what we need to get it done. And me being a contractor, it's like, I want that job. I want to build this relationship. So I went ahead and actually worked on those terms. Right. So now I'm juggling 3 different scenarios, 3 different terms, and I'm getting punched in the mouth. And all of these things look to be potentially breaking ground around the same time, which is going to be chaos for me. Now, I've been able to negotiate some of those terms, right? Where I'm going back and talking to the private entity about, okay, once I order steel, I'm going to get this amount. Once we get the permit, I'm going to get this amount. Once I order windows, I'm going to get this amount. So I'm still kind of like protecting myself, right? Being proactive on that particular contract, with the VA loan, really trying to expedite and fill out the right paperwork, fill out the forms, talk with their VA lender, and actually know that, hey, even though I'm only going to get 5% down when I start, right? Once I get the permit, once I get this, I'm still trying to get some sort of front end loading on these contracts. And front end loading, and maybe you can provide some insight on this too, but front end loading to me isn't because I want all the profit up front. It's kind of a necessity, right? Because I need to be able to put down deposits to my subcontractors, order the long range material items. Like if I'm ordering cabinets, that cabinet maker wants 50% down up front, right? So it's like there's as much outflows. So I need to be able to protect myself to get the inflows because I don't ever really want to be financing the project for the owner. That's the owner's job is to finance the project. Any comments on that? Thoughts on that? Like I'm going through it right now.
Do you know what it is? It's not, you're actually not, yes, you're front loading the job, but it's not the profit. It's actually those cash flows. It's that need
Yeah.
from it. but it's also looking at trying to see where you have the flexibility in the bending of the terms, and working with the different ones with the delays, and trying to schedule them maybe with the VA loan, because there's so many pieces. There could be a couple, maybe you can delay the start of that by a week just due to timing and everything else. So it's really paying attention to the finer details when we're doing those front end loadings.
Mhm.
And unfortunately, sometimes that's when we're leaning into that line of credit and just using it just to help us get things going, knowing that once that ball starts rolling, we're going to be getting more of those
Mhm.
draws in a quicker time. Because a lot of times your banks control when they're going to pay you.
Mhm.
And and they can make promises, but sometimes if they feel you haven't met that milestone or whatever, they might say, "Oh, we still want this to be done." We have to be prepared for it and have those back pocket line of credits and those abilities to negotiate with our suppliers. It
That's
really
exactly.
becomes it's a cat
Yeah.
and mouse. You're chasing one and to do the other, and it's hard. This is what happens when you're playing in those bigger jobs.
Mhm.
You have to become more strategy wise, and you got to pay attention and have all three of these jobs and each of those scenarios, thinking about what those delays and scenarios can be and how they can impact your cash flow, and what
Mhm.
can you prepare beforehand
Yeah,
to
we've
help.
definitely had to tap into the line of credit for that, and we've been proactive in having that established. Cash flow has been a big thing for us as we've grown, right? We had really good insights on cash flow when we were small, and then as we grew, we kind of got complacent. Other things took priority, and then here we are, and felt the pinch, and then we've got to go back and like reestablish some of our cash flow habits and protect that time to focus on it. So, being busy isn't always the same as being profitable, right? And being profitable isn't the same as being liquid with your cash flow. All right. And if you're a contractor out there, you're having your best year ever from a revenue standpoint, and things still feel tight. Again, as Anna and I are saying today, it's not necessarily a cash flow problem. It's really the systems problem and having that. So it is a cash flow problem, but it's the system of having a cash flow process. All right. And having the right financial terms in your contracts and financial terms with your sub suppliers and your homeowners that make sense to protect yourself from any cash hindrance. And then having that backup of that line of credit to be able to protect you in an instance that something does happen. All right. So if you want some eyes on your numbers, if you're a listener today and timing and draws and contract terms and all these things are kind of stacking as you grow and scale, I would love for you to book a Profit for Contractors calibration call with our team where we can help you find exactly where this pressure is coming from and how to alleviate it. Okay. Again, this is Austin with Profit for Contractors. Anna joining me, our financial coach inside the walls of PFC. New episodes and trading tips drop every Thursday. So make sure you subscribe and don't miss the next one. Anna, thank you so much for your time. Have a great day. I'll see you on the next one.